Okay, hello and welcome everyone to today's webinar. As we all know about the market sentiment around the recent ODI regulations, we have experts today to discuss about how it's going to affect the startup activity, especially when it comes to mergers and acquisitions, and also from an investor's perspective, how easy will it be for them to pool money from external plus domestic investors and also invest offshore in different companies without having any Indian connections. So it definitely is a bold move by the central government and RBI, and it remains to be seen how it pans out in real and practical experiences across companies. So before I start with the questions, I would like for the speakers to introduce themselves for a minute, starting with Vaibhav.
Hi, good evening, everyone. My name is Vaibhav Gupta. I'm a partner looking at M&A tax at Dhruva Advisors, Delhi. I specialize on M&A structures, advising various companies, including startups, on creating their structures in terms of whether it is about acquisitions or overseas holding company structures. I advise on that from a tax and regulatory perspective.
All right, thanks, Vaibhav. Utkarsh?
Hi, pleasure to be with you all today. I am Utkarsh Sinha. I run Bexley Advisors, which is a boutique investment bank. We focus on early stage transactions in tech and media, and we also help funds, with their fundraisers. So we help young funds find LPs for their funds, and finally we also serve as consultants to young companies. We give them advice on how to structure themselves, how to set themselves up for long-term success.
Okay, thanks, Utkarsh. Krishna?
Hi, this is Krishna here. I have recently joined the KNAV practice in Bangalore. KNAV primarily is an accounting and consulting firm which renders end-to-end services, which pretty much every consulting firm, whether it is in the Big Four bracket or in the Tier 2 firms, render. And my specialization pretty much falls under everything within direct tax, because I have experience within corporate tax, transfer pricing, expatriate tax, as well as M&A tax. And the focus for today's event also is to shed light on various aspects which I can touch upon.
Cool, thanks, Krishna. And Devakar and I will be the moderators for the session. To begin with, the biggest relief that the government has come up with is that the round tripping is now approved. I mean, you don't really have to seek approval for it or be under the radar for doing it. It's legitimized. So how is that going to affect more startups, doing transactions concerning round tripping? Utkarsh, if you could give us your view on that, since you deal with a lot of startups and help them with fundraise.
Sure. I think, before we get into the specific issue of round tripping, what's important to note and reasonable to note is that there's a progressiveness to these new regulations, which indicate that the protectionist mindset which has been there about currency holdings and foreign investments in the past, that is something which we see going down, and we're seeing implications of that in several aspects of the regulation that has come out. In terms of specifically in terms of round tripping, I think we deal with very young startups, but so it wouldn't it's not going to be of a lot of impact to very young startups. The ones which are more mature, it ends up being valuable to them, because especially in terms of whether when you're opening up operations internationally, if you're opening up the operations internationally, if you're trying to list your company internationally, if you're trying to open up a subsidiary internationally, those are aspects in which you have to jump through several hoops to be able to get the right set of approvals. There are certain investors who would have preferred to be able to invest in a Mauritius entity or in a Singapore entity or a Delaware S Corp, C Corp. Getting those things set up has always been a nightmare. Those are all things which become a lot easier. I think it still remains for people like Vaibhav from Dhruva to figure out what are the exact mechanisms to enable that to happen in a seamless way. But at least from a regulatory perspective, the pathway to that has been clear, which we'll start seeing impacts of that down the line when it comes to being able just the ease of raising capital internationally is going to be improved as a result of this, when there's no hindrances to where you are operating and how you're setting up the company structure. You're free in many ways to be able to do it in the way which makes the most sense for the most business sense for you, rather than having to look at the regulatory pathways that are predetermined.
Got it. And it's just been a week or so that the regulations have come out, but have you, in your experience, seen some of the transactions already taking place?
No, not in the week, but I mean, we have encountered situations in the past where where this has been a hindrance in terms of moving forward. So, for example, there was a company which was doing fairly well in India. They wanted to set up a company. They wanted to set up operations in South America. When they started setting operations in South America, they realized that it would be much better to actually set up a Delaware C Corp or an S Corp, and have both the entities be controlled through that. But just the mechanism of that was so cumbersome that they just went ahead and did a completely separate entity. Those kinds of things become business decisions do not have to be encumbered by those kind of considerations, I would say.
Got it. Vaibhav, this rules will also, of course, encourage more and more startups to incorporate outside India since the rules have been relaxed now. So what's your take on, startup externalizing out of India and setting up their bases outside?
Yeah, absolutely, Radhika. So in fact, first of all, a very, very welcome change. They've blessed round tripping. Of course, it comes with certain safeguards in terms of what you can do, what you can't do. But what will definitely happen is that it will enable startups to create structures outside India, holding company structures outside India. And as Utkarsh rightly pointed out, there are situations where various global investors are not comfortable to invest into an Indian company, but they would prefer a Singapore or a Mauritius kind of a structure, which until now, not that it hasn't happened, there are several instances where things have happened, but it used to be a nightmare from a tax perspective as well as from a FEMA perspective, particularly when the founders are Indian residents, right? I still remember a couple of years ago when Renew Power was listing at the NASDAQ, and we were fortunate to be involved as part of that transaction. We all went through several hoops on what is possible, what is not possible, because the founder happened to be a resident, and there were, of course, several resident shareholders that the company had. So all those complications from a FEMA perspective now, in that sense, go away. However, what I will still say is that the way the regulations have come, one needs to still be careful. There are various safeguards that one needs to consider. Just as an example, what they have really permitted as part of the entire round tripping clause is that you are entitled or allowed to invest into a foreign company, which can have subsidiaries back into India, provided you don't have more than 2 layers of subsidiaries. Now, if you read it very carefully, what is allowed as part of ODI is investment into a foreign company which carries out a bona fide business activity. Now, a situation where you create a foreign holding company, and if that foreign holding company has only one subsidiary which is in India and it has no other activity, would that qualify as a bona fide business activity, and is that kosher or not? So that is one question that one will need to grapple with. Of course, these regulations are new. As time passes by, we'll have multiple clarifications come up from RBI through the AD bankers. We'll have AD bankers take up their positions and clarify. So it will evolve. But I think purely from a regulation perspective, the entire thing on bona fide business activity is an important point to consider. And secondly, again, the entire aspect on ODI in financial services activity, and how does that interplay with a pure holding company structure outside India, because there are still riders on making overseas direct investment in a company which is engaged in financial services activity. Technically speaking, a pure holding company which is engaged in nothing but investing is also a financial services activity. And hence, are you then subject to restrictions under the current regulation, also the new regulations, when it comes to making overseas investment in financial services? So those are things that one will need to still carefully plan around.
Got it. But Krishna, tell me this thing that, of course, while advising, you also see the bad part of it, apart from the good things. So do you think this can be misused, so much of relaxation given by the government?
So it is actually two-way, because if you look at it, while some of us have, even in the news clippings and articles, if you keep saying, most people have read it out as entire liberalization, but it is not entirely complete liberalization, because there are checks and balances across the board. So whether you look at, like Vaibhav was mentioning, whether it is ODI in financial services, there are going to be regulations which are going to specifically observe those specific provisions. So, and even in terms of NPAs being monitored, in terms of the 400% limits continue to be applicable. So overall, if you see, yes, there is a sense of liberalizing in terms of the ODI as well as the OPI sectors, which were earlier not clarified. In those sense, yes, there is liberalization, but in an overarching sense, of course, there is going to be checks and balances throughout the board. And if at all anything, if you see the arm's length price concept has been introduced for various transactions. So transactions necessarily have to be carried out at fair value, which means that most of the transactions invariably will pass through a level of filters within the system. Of course, in terms of the ease of compliances, there are certain easing of compliances which have been carried out, but that more often than not tends to percolate at the ground level in terms of the final reporting requirement, not at the broad level where you can say that, okay, this is going to be misused. And even in terms of the round tripping structure, where we are saying that is there potential for misuse, even in that instance, they've effectively capped it by saying that there is only going to be a potential for 2 levels of subsidiaries. And even within the 2 levels of subsidiaries, the foreign company necessarily, the foreign subsidiary of the Indian parent necessarily has to have control, which then means that whatever is sought to be achieved or allowed through the ODI provisions will be continuously monitored by the RBI through its various agencies.
Got it. Devakar, over to you.
So my question to Vaibhav will be, with the relaxation on the round tripping structure, how will it impact the startups' fundraising plans?
Yeah, sure. So I think, touched upon it briefly earlier. It's a very big positive, first of all, right? To say that there is a structure in which global investors can come in seamlessly without having to worry about the country risk that India has, perceived. There is a perceived country risk that India has. Right. That's, I think, making a statement to the world that as Indians, as Indian businesses, we are ready to accept global investment, and we are ready to create structures where we don't really need to worry about law. We don't really need to worry about enforcement, coming to hound us. I think that is one very clear positive. And not just raising money from private capital from global investors, also looking at the overseas capital markets, and just the sheer ability to list outside through the holding company outside India becomes very, very critical. Because even today, Indian companies can't directly list on global exchanges. So if you have to list on a global exchange, you need a global holding company, and this enables that. So both from a private capital as well as from a public capital perspective, this is a very big positive for enabling startups to raise funds.
So how would it impact the SPAC type structures that were quite popular before this rules came in?
No, I think it's a positive impact. So the Renew Power was a SPAC, right? And even for listing through the SPAC route, they had to flip and create a holding company in the UK, which then listed on the NASDAQ, right? So whether it is a SPAC or whether it's a direct IPO, today, as the Indian rules stand, an Indian company can't directly list. So you need a holding company.
Right. And how would it affect the M&A plan of the Indian companies when they are planning to acquire foreign startups? Especially now, they can get access to their own investor set. Like VC investors can also can invest in overseas startups as well. And in overseas market, unlike in India, I think you can use the debt also to fuel the acquisition, to finance your acquisitions. So how will that impact, especially regarding the M&A plans?
Yeah. So I think there is a new clause that they've brought in which enables investment into foreign startups, right? And they've mentioned and clarified that you are allowed to make investment in foreign startups, but only use funds out of your internal accruals, right? Which means you can't really have leverage on your balance sheet and use that debt to invest into foreign startups. So while there is a way to, and there is, the rules now allow you to invest into foreign startups, I think the confusion that would come up, and which is where maybe, the clarity will emerge over a period of time, is how do you define a foreign startup? What is a foreign startup? There is no definition which is provided in law today, right? And hence there is ample room to interpret it in a manner one wants to, because if you are able to raise debt and invest into a foreign startup which doesn't qualify as a startup, then the investment that you can do and the access of capital that you can have will be completely different.
Oh. But in terms of like foreign startup, like, so wouldn't it be like a startup specifically recognized, let's say, for example, a US company, US based target? So wouldn't that include a startup domiciled in the US, which is recognized under the startup in the US? Wouldn't that automatically get recognized here as a startup, or they are going to come up with their own regulations like they're done for DIPP here?
No, I don't expect them to come up with their own regulation. But the point would be that not every country would have definitions of startups, right? India needs to promote entrepreneurship, and hence there is a definition of startups, and there is the whole host of incentives. But not every country may define startups, and hence then it is left open to the interpretation of AD bankers. How do they look at an investment?
Got it. And thanks, Weber. My question to Utkarsh will be, now the new rules have also permitted AIFs and domestic VCs also to invest overseas. How will that enable the VC-backed acquisitions by Indian startups? And since now they are also allowed to invest overseas, will that impact some form of capital availability for startups in India as well?
There are two aspects to this. One is the fact that AIFs are now allowed to make investments in international startups is definitely a positive, because again, it removes a roadblock. Right? So if there is an intention for somebody to do it, then they have the ability now to do it, or at least they don't have to jump through certain hoops to be able to get the ability to do it. So that's a positive. But that said, fundamentally, we know a lot of AIFs, and we work with a lot of AIFs in India. There aren't a whole lot who have this as a pressing problem, that they are looking to make investments abroad and they're not being able to do it. And those who want to make those investments abroad, they have, they very easily can go and set up a Mauritius entity which can, do that. So this does remove that one step. Most of the capital that is being raised in India, whether it is from Indian LPs or international LPs, is being raised for being deployed in India. In fact, in most cases, there are certain clauses that prevent them from deploying their money elsewhere. So it is, as of today, this is not a pressing problem that this solves. But what it does do is it clears the pathway down the line for Indian investors to start, Indian VC investors and their private equity investors to start thinking broadly, right? And to start thinking about which is the best, destination for getting returns on their capital. For example, very naturally, if I think about it, it might just be that, a VC fund which is raised in India can get some excellent returns in a place like Bangladesh, which is growing way faster than us, right? So those are opportunities which were not even available earlier. Now, people who are creative about it can at least start exploring that. The second aspect that you highlighted, which was to do with M&A, I definitely think that this is going to serve as a positive. But again, as Weber pointed out earlier, a lot will be left to the interpretation going forward, because the whole point about it having to be from accruals, right? So if I am a startup, you are a VC, if I raise fresh capital from you and I use that capital to do an acquisition, then that's capital that is sitting on my entity. That's not capital from my accruals. Can I use that capital to do an acquisition? If it is you who's doing it as the VC, right, you have the ability to do that, but then how does it come into how does it serve as an acquisition in my entity? So those are all things which need to be ironed out, and I'm sure there's some precedents will be set over time. But the fact that it is something which is doable definitely makes it means that people will start exploring it, and a pathway will be cleared and found in some time.
And in these terms of regulation, while it has highlighted about the acquisition, where the foreign target could become a subsidiary of the Indian holdco, how does it impact the merger? So I'm illustrating a scenario. For example, an Indian company wants to acquire overseas. Now it can use up to the reserves that is allowed as per the clause on the net worth or the internal accrual, as Weber pointed out. It uses that much capital. Now they need additional capital, which a VC investor, their VC backer, can directly invest into that startup while keeping a minority stake in that overseas company. Now later on, you decide to consolidate the accounts. Can you does the new regulation permit an outright merger where the foreign target can actually merge with the Indian company?
I would not be able to answer that. I think somebody who's got more of a tax background will be able to answer
If
that.
I may step in there,
Yeah,
the new regulations don't really need to facilitate that. There is already a regulation which is the RBI cross-border regulations, cross-border merger regulations,
right,
which facilitate mergers of foreign companies into Indian companies. The Indian company law, of course, permits it.
Okay.
What is important is to see whether the jurisdiction of the foreign subsidiary is in a country which permits an outward merger. So just as an example, if the foreign subsidiary was to be in Singapore,
right,
Singapore company law doesn't permit an outward merger.
okay,
You can't merge out of Singapore. Whereas if this was in Mauritius, then a Mauritian company can very well merge into India.
okay, got it. And if you can throw a light on the India connection for the VCs, like they said that it does not require India connection. Could you elaborate a little bit on that? What is an India connection and what is not an India connection in this context?
I think what they're trying to say is, there's always been flow of capital into India, right? And India has been for a long time and hopefully will continue to be a good destination for capital. What I think this means is that India does not have to serve only as a destination for capital; it can also serve as a source for capital. Right now, whether Indian LP, the limited partner network in India is fairly underdeveloped. Right. So,
Right.
If you think about institutional investors in India, if you think about HNIs in India, very few of them are active participants in the LP base of Indian VCs.
Right.
Part of the reason is that, if they're seeking returns in India, they have better avenues to do it. Right. They have more liquid options to do it, which give, comparable returns, if not comparable returns, at least more predictable returns. The moment and similarly, they don't have access to, like, if you've got 100 crore, if you have 100 crores to invest into a fund, you are not going to be the kind of LP who's going to be able to go and buy into a Sequoia, Silicon Valley fund, right? As an LP.
Right.
What this opens up is the ability for Indian VCs to be able to invest abroad, and therefore gives access to Indian institutional investors and HNIs to participate in those investments as LPs. So that avenue is opened up, and therefore there's a bidirectionality which gets introduced into the flow of capital. I suspect that it is not going to be monumental to start with, but as soon as a trickle starts, there are certain people who will emerge who will have, all it takes is one company, one individual, one fund to be able to deliver a lot of success, and then a new market class will just get created, right? Like I gave the example of Bangladesh. It could be anything else. It could be Indian investors investing in Israel, right? So whatever it might be, if that avenue is opened up, I think a new channel gets carved.
Okay. And Krishna, like it has been mentioned that the new norms would ease something on the compliance side of things. So could you illustrate a few examples with respect to the startups?
Yeah, so in a few instances, it depends on the applicability of who and all are going to fall within this. But if you have an equity investment of say less than 10%, the annual performance report is no longer required to be filed, which means that earlier, if you're holding in whether like 1% or 5%, you had to necessarily make performance report filing if you had made a ODI investment. That is no longer required. Again, instances of delayed filing or non-filing, that seemed to be condoned a bit. So for instance, there is an introduction of a late submission fee, which was earlier not there.
Right.
So there is going to be a late submission fee, which under which you can effectively regularize your filings up to 3 years.
Okay.
Effectively, what is the implication of this is maybe potentially the compounding could be taken away. Again, it depends on how the compounding rules evolve. Effectively, once you file the late submission fee, once you make the payment of late submission fee, you should be able to regularize your filings. Beyond that, also adjusted or a related note, if you tend to make ODI investments consecutively, repeatedly, without compliance of the reporting requirements, there's a catch which has now been introduced, which means that if there is a failure or a delinquency in reporting, you cannot make further investments until you regularize those reports.
Okay. So does that for the individuals, does that the limit of $250,000 a year still stays intact, or has it been increased in the new rounds?
That limit continues to stay as it is.
And same as for the VCs also, right? Total AIF investment, or what it was, 1.5 billion or something was like that, or is it that the limit remains the same?
The limits pretty much remain the same.
Okay. No, but it has allowed that if you have exited from some startup, then you can roll over the capital and continue with the new startup if you want to be.
Correct. See, in addition to what we were discussing with a couple of earlier points, I think what has effectively happened is, if you look at the overarching provisions of what the ODI regulations intended to achieve, effectively it is a foreign exchange provision, which means that how much is the foreign exchange that we are having within India, and are we comfortable of funds flowing outside of India? So when we say whether it is the round tripping issue or the overseas investments are being permitted to do, it is effectively capital outflow which is happening. And while capital outflow is happening, whether it is by way of the round tripping issue or by way of allowing of investments overseas, effectively it is the government control of how much capital are we willing to permit outside. And that is where the checks and balances do come in. So even with the round tripping issue, that is exactly what is happening in relation to one of your earlier points as well. That once you see what is sought to be achieved, funds are effectively coming back into India, even under the round tripping route. So the government is keeping controls across the board on all of these aspects.
So this is more of a signal and intent in terms of the announcement, more on the signal and intent, but still maintaining the regulation around.
Exactly.
Right. Okay. And Weber, what are the sectors within the startups where you think most of these regulations are going to benefit them for doing the overseas acquisitions? Which other sectors will you see more activities going forward?
I think that's, difficult to take a guess, but purely based on experience and what we see in the market and a number of startups that we are working with on various fundraise structures, I would expect a lot of activity to continue to happen in the tech space, whether it is a fintech or an edutech, right, and maybe in the D2C space as well. And then the entire clean tech and EV space is something that we feel a lot of activity should happen. India is producing a number of good startups in EVs, and we're working with a number of them on on VC interest in some of these. So I think some of these sectors are where there is global interest in investment, and hence any easing of regulations should directly benefit them.
Radhika, what do you?
Yeah, maybe on that question, Utkarsh, you can also answer since you're very much.
Sure. I think I concur mostly with what Weber said. Tech will be a big theme, and I think particularly fintech, because I think India has led a lot of innovation when it comes to fintech. The UPI architecture, for example, is something which is phenomenally solid architecture, and can serve almost like a TCP/IP level kind of a protocol for enablement of fintech in any economy. So anything which is developed around that and on top of that is something which is ready for export. And I think the ability to be able to deploy capital internationally will bring with it the ability to be able to export technology as well. And so I think a lot of the fintech innovations that have happened in India, there's a reasonable chance that some of that can be exported internationally. The other thing is India, a lot of the VC investments in India have been towards driving the consumption boom, right? So India has had a consumption boom. It's going to continue for a while by the looks of it, and a lot of so-called tech that we call it, which is basically tech-enabled consumption, has been fueled through the flow of a lot of VC money. What has not happened at the same clip is investments in manufacturing, investments in deep tech, investments in fundamentally new technology which requires any kind of manufacturing ability, any kind of R&D. I'm not saying it has not happened, but I think it's a fraction of what has happened on the consumption side. And because of that, there's a gap between what is available outside India and what is available in India. So Indian investors who are looking to get exposure to some of those sectors which they have not been able to invest in India will now be able to seek out some of those opportunities internationally. So I know, for example, there were investors who were looking to invest in certain things to do with garment manufacturing. Right? India made the opportunities which were available to them were very limited. Those opportunities will be manifold more to them in places like Bangladesh and Indonesia. There were some people who wanted to do something in the space of chip manufacturing, right? Now they had the capital to deploy, but they didn't have any company in India which had reached that level of maturity. Now they can wait 7, 8, 10 years for the market to mature, or they can go and make investments elsewhere, have that maturity, and in all probability that leads to maturity in the Indian market as well. If Indian investors, I mean, one of the reasons that Silicon Valley has such a tremendous position of leadership is because not only have they created their innovations in their own backyard, but they've also funded the innovations across the world, whether it is Israel, whether it is China, whether it's India. So there is a symbiotic effect of that happens in your own backyard as well. So I'm hoping that if there is capital at scale which starts getting deployed from India abroad, and this whole, I mean, I don't know about you, but when I was growing up, India's forex reserve was something which was on the tip of our tongues, right? We knew it has 20 billion hai, 40 billion hai, and it was a mark of achievement that, hey, we have hit 80 billion, we have hit 100 billion. So there was an attitude of scarcity around the forex reserve. This move shows that, hey, capital will flow. We just need to make sure that it's not one directional in a very permanent way, but capital will keep flowing. We don't have to be insecure about it. And if that insecurity goes away, then that flow of capital will create deeper links, which will actually end up benefiting the ecosystem back home. But it has to happen at scale. I mean, we cannot expect a miracle overnight. As I said, if 1 or 2 people come up as a result of these kind of regulations and they're able to demonstrate success, hopefully, in 5 to 7 years, we can see an industry formulate which makes investments from India abroad.
So are you seeing this as a trend towards capital account convertibility or rupee at some time in future?
No, I think we should not have such pipe dreams.
Okay.
I think US dollar is here to stay. China, the Chinese have not been able to displace that. So if you look at SWIFT transactions, 2% of SWIFT transactions is renminbi, right? Mm-hmm. On a daily basis, and a bulk of that 2% is China to Hong Kong, because that also happens on SWIFT. Right, so euro has a certain percentage. US is dominating that, right?
Right, of course.
And I don't think that anybody is playing such an active role in making sure that we can become the reserve currency of the world. Our GDP is not that size yet that we can hope for that, and transactions are still settled in US dollars. So in fact, one of the biggest problems that we face is the fact that we are raising money in dollars, but we are providing returns in rupees, and there's no predictability around that. Mm-hmm. One of the funds that we are working with, they have been able to provide 6x returns in rupee terms, but they raised capital when it was half, so that has become 2.5x in dollar terms, right? So right. I do not. I do have dreams, but I am realistic.
Okay. So how would specifically to asking Krishna, so how would the new investment rules help startups in attracting good talent, both in domestic and overseas, particularly with respect to granting or ESOPs? Because especially for startups, to get a good people, sometimes you need to grant ESOPs. So how will that impact?
Yeah, so the ESOP regulations have fairly been liberal even under the earlier regime, continues to be the same even under the present amended regulations as well. But there's one phrase which is introduced in this new regulation, where effectively it says the employees can subscribe to employee stock option plan without any limit. And that phrase was not there earlier. So whether does it make any difference or doesn't make significant difference, but that phrase has been used, and the phrase also continues saying that as long as it is globally and uniformly being allowed for other employees. So therefore, if there is a company which is sitting in US saying buy 1 crore shares of my company, there's a single employee who can subscribe to that, that can't happen. But if you're saying that every employee is being provided with this opportunity, every employee can subscribe to this. So that is the only limit which is there. That is the only amendment which has been sort of provided. But in other terms, the employee stock option plan was there even earlier as well. So the Indian employees could subscribe to foreign company shares, and all of that was permitted even earlier. And
does that apply to the same for the foreign employees into the Indian holdco?
Sorry, what is it?
For the foreign employee, let's say if I acquire a company overseas, yes, and the US citizen, for example, can he hold ESOP in my Indian company?
The regulations seem to talk about the shares in the foreign company. I'm not sure if it speaks of shares in the Indian company.
Okay. So it's not clear on that.
I don't think it's clear.
And so that doesn't need to be covered in these regulations. Sorry for coming in there, because shares of an Indian company held by a foreign citizen is more FDI and not ODI. So the overseas investment rules don't need to cover it. But just to answer that question, whether foreign employees of foreign subsidiaries of Indian holding companies can have ESOPs in Indian holding companies, the answer is very much yes.
Okay, got it. And in terms of when you're creating this overseas holding company structure, what are the safeguards you should keep in mind when you are creating such structures? Weber?
Sure. No, I think a number of points there. One is that if the founders happen to be residents, right, then it really depends as to what is the, so there are a number of factors which would determine and how do you create that structure. One, of course, is what is the kind of stake that the founder has in the company, right? And if it is a controlling stake, because what the regulation permits is for resident individuals to make ODI into a foreign company which is not listed. However, there are certain riders to it. One of the riders is that a resident individual is not allowed to make ODI in a foreign company which is engaged in financial services activity. Okay. Second point there is that in case the resident individual has got control in the foreign company, and control is defined to mean more than 10% shareholding or control over management decision making, then this foreign company is not allowed to have a step down subsidiary. Now, whether that step down subsidiary is in India or outside India, it doesn't matter. The foreign company cannot have a step down subsidiary.
Okay.
Which basically means that in the context of creating overseas holding company structures for Indian startups, where the overseas holding company will invariably have the Indian company as a subsidiary. Okay. If the resident founders have to have control in the overseas holding company, then investment through the individual route probably doesn't work the way the regulation stands today.
Sorry, Vaibhav, can I ask you a quick question over here? Correct me if I'm wrong.
Sure.
But this particular aspect in practicality will create more problems than solve solutions, right? Because the moment you say that you cannot, the two-layer subsidiary thing will become a hindrance very quickly when it comes to practical.
Absolutely. So in fact, even before the new regulations came in, right, the way the old regulations were, where Indian residents were allowed to incorporate a joint venture or a wholly owned subsidiary outside India, using the LRS limits, but under the ODI regulation, the erstwhile ODI regulation. There again, there was this restriction that while you are allowed to acquire shares of a foreign JV or VOS, this foreign JV VOS cannot have a step down subsidiary. Now that was sans the entire round tripping thing. Even if you have a subsidiary outside India, that was also not permitted. Right now, they have retained that in some form and spirit to say that if you have that restriction only applies if you have control. Until now, that restriction applied even if you didn't have control.
Sure. Okay. So it's somewhat better, but not exactly. Right?
Yes. Now, of course, there are ways and means to structure it. The restriction applies on a resident individual. It doesn't apply on an entity if an entity is making the ODI. And hence, can a resident individual form a company or an LLP in India and structure his investment through that, so that you're out, past the restriction, right? Yeah. But the other points that will come in handy here are that if the foreign company is a pure holding company and doesn't have any operations, all it does is it has subsidiary in India and let's say Israel, wherever, operating subsidiaries outside India, then it is purely in the business of making investments. And isn't the business of making investments classified as financial services? Because they have also brought in a definition of what constitutes financial services activity as far as a foreign company is concerned.
Yeah.
They've said that if this activity was to be done in India and if it was regulated or you required a registration, then it qualifies as a financial services activity. So a pure holding company outside India, if it is only doing investing, then it qualifies a financial services activity, and a resident individual is restricted from making ODI into a financial services activity. Now, again, coming back to my earlier point, whether we can still use an Indian company or an Indian LLP, which is owned by the resident founder, to invest into such pure holding company. While possible, again, various things to be taken care of, where one is, of course, you need a profitability track record for this Indian company or LLP for 3 years. And if the Indian company or LLP again has nothing else but only investing, then it needs to be regulated by RBI and you require an RBI approval. However, if one can really structure some operational activity into this Indian company or the Indian LLP, then you are perhaps able to do it under the automatic route without any RBI approval, but you still need a 3-year profitability track record. So while on the face of it, the regulations look to be quite liberalized, the point I'm trying to make is that there are a number of considerations and a number of safeguards that are still required to be put in place.
But that comes to the point, Vaibhav, is that most of the startups, if you've seen even the unicorn ones, well, almost 80% of them don't report any profits. So how will that impact them in their overseas acquisition? Because if you're not making a profit, then and if you have a clause of 3-year profitability, then internal accruals can't be used, right?
No, so the point is that the 3-year profitability track record is only for investing into a financial services.
In the financial services,
not into a non-financial services operating activity.
Okay. And will you continue seeing those structures where an Indian entity establishes a subsidiary in the Netherlands and then invest through that, make the global acquisitions through that?
I think that is driven more by tax, I would say. And so maybe not just tax, but a large part by tax, but also on the ability to raise funds outside India. And if there is plan to have more overseas subsidiaries, then does an intermediate holding company like a Netherlands make more sense? And of course, it is tax efficient without any doubt.
But then that Netherlands holding company, which is basically making those financial investment, that will again might come under the definition of a financial services, right? If you're making just the investment purpose.
I agree, except the fact that if you are making investment into a business activity which is effectively non-FS, the downstream subsidiaries,
right,
right, then can we view the Netherlands company as an SPV, which is permitted, which was permitted under old law also and continues to be permitted now.
Got it. So it's basically how you interpret the regulations and how you go about doing it.
That's right.
Yeah, I think, well, correct me if I'm wrong, but this case law established on में थोड़ा time लगेगा and that will be pretty critical, right? You know, what is a lot of the interpretation will be figured out through exceptions.
I would agree with you, Utkarsh, and I think we should be prepared as advisors to startups and as startups, business owners ourselves, that there will be a lot of teething troubles in the interpretation of these guidelines. How will bankers view it? Because at the end of the day, a banker has to allow a remittance.
Mm-hmm.
So those kind of things will come in, and hence, you need to be prepared, plan well in advance, and have sound advice before implementing anything.
Fair enough. Radhika?
Yeah. So, Krishna, coming to you, I wanted to know that these rules, will it be more advantageous to equity-related deals or debt deals in general?
Either way is fine, yeah. Because if you look at it, even the debt-related provisions have been simplified as well as equity. And that is where I was mentioning even earlier as well. To some extent, the ODI regulations and OPI has also been eased out. And obviously OPI with listed debt securities and ODI in general has been opened up. So both in that sense has opened up. And overall, even in terms of the flexibility which has been provided, compared to the earlier provisions, some of the guarantee and the performance guarantee related clauses, they have also been eased out. So in overall terms, yes, both have been eased out. If you ask me whether equity has been more eased out compared to debt, I would say maybe debt is comparatively eased out slightly a bit more because of the performance guarantees being eased out under the overall framework.
Is there anything in relation with investing in listed or unlisted NCDs as well?
Listed and unlisted?
NCD.
No, there's nothing on that which is there in this regulation.
Okay. And if we have to draw a comparative analysis just to show our audience as to what has changed now and what was present earlier, if you could give us a few pointers there.
Under the overall regulations itself, is it?
Yeah, like what was there before? And of course, we know what is there now, but what was the condition earlier?
In the context of overall investment, you're saying?
Yes.
Or the ODI regulations itself?
From the ODI regulations.
So some key, so the way to look at it is most biggest changes I would say is in terms of the definitions itself, because here we were not having specific definition. So whether it is the definition of the phrase control, where the foreign entity has now been asked to observe whether the 10% voting rights has been satisfied or not, or the definition of Indian entity itself. So for instance, earlier, there was the concept of Indian party, which is now being specifically replaced with Indian entity. And the Indian entity has specifically been included to cover company, body corporates, or LLP or partnership firms. Apart from that, there's one other significant difference in terms of net worth as well, which I would add. Because net worth has now been specifically defined to include securities premium as well, which was not the case earlier, because under the earlier regulations, net worth included paid-up capital and free reserves alone, and securities premium was a bit of an open issue. And apart from that, there are specific definitions of subsidiaries, step-down subsidiaries in the context of the foreign company, which was obviously not there earlier. There is something known as a strategic sector, which has been introduced, which has been defined to include energy and natural resources. It includes oil, gas, submarines, cable systems. So those would be the broad changes. And apart from that, in terms of the key highlight change, I would say is the classification of ODI and OPI itself, like what we were discussing earlier. And the overall ambit of defining ODI first and then saying everything other than ODI will fall under OPI, subject to it being listed or being less than 10%.
Got it. Weber, speaking about encouraging investors to come through the gift city, there has been some amendments made there as well. So how do you see more investors coming to the gift city to set up their funds or pool funds into the gift city vehicles?
I think that's again a very positive change. In fact, just this morning I was with a investor and they're very, very actively looking at creating a pooled vehicle in gift city. So while India will still, there is still some time away for the gift city to develop as a global IFSC the way it is meant to be, but the government is making all the right moves, whether it is regulation, whether it is tax, right? And so in that sense, I would expect activity to start coming in. It could be slow in the beginning, but I think over the next few years we should expect a lot of things. So I think there is a clear commitment and intent from the government to encourage gift city as a platform to make overseas investments. That continues to to be demonstrated through various regulatory changes that we are trying to make. The tax framework has also been clearly specified now. So yeah, I think a very positive change. I would expect some action to at least start showing up now.
Okay, but you said that the change will be rather slower, although a lot has been improved since what it was in Gift City. What else can we, bring in?
No, I think it is more also clarifying what does it mean in terms of if there is a domestic connection with a business which is set up in Gift City, then how does the government look at it? I think those kind of things will evolve over a period of time, and that is why I mentioned that this will take, maybe it will not happen as fast as one would expect it to happen, because to expect a global company to come and set up in a Gift City for their global operations, that could be getting a bit overambitious. We should expect Indian businesses and Indian entrepreneurs to lead that. And because Indian businesses and Indian entrepreneurs will more likely than not have some Indian overlap with that setup in the Gift City, I think that is where there is, the action will evolve as regulations also, evolve and interpretations come. I think that's the reason I had mentioned.
And also, Well, correct me if I'm wrong, but the interface between GIFT City and the rest of India is still, the boundary conditions are still being figured out, right?
Right.
So unlike, if you go to say Abu Dhabi and you are say with ADGM, which is a self, contained, ecosystem where you don't have, your British common law is there, you don't have to worry about anything else. If you are in GIFT City, the whole interpretation of how does SEBI impact you, how does RBI impact you, Ministry of Finance ka kya rules and regulations hai, those are all things which are still not entirely sorted yet. So,
Yes.
Something like this, again, our discussion is centered around, overseas investment rules, and that is definitely, a positive thing. But we should recognize it for what it is, which is a clearing of a roadblock. It is not a fundamental innovation in terms of moving the country forward in a very drastic way, right? So, and these are all important. So, I'm not trying to diminish the importance of clearing such roadblocks, but it's not a one fit solution to all problems that we have.
No, I would agree with you, and it's a step in the right direction.
Absolutely,
You rightly said, a lot of regulations, SEBI, RBI, income tax, all of these will evolve. The government is just making all the right moves.
Yeah, agree.
Yeah, that is a positive statement to end this webinar with, that there is a positive change and we should expect something more coming in. But we were running short of time, otherwise had a lot of questions more. Hopefully next session we'll cover when we see more changes from the government coming in. But for now, thanks a lot, Vaibhav, Krishna and Utkarsh, for your time. And we have Utkarsh, especially you coming back with the questions and keeping the discussion more engaged. It's really nice to hear that.
Thank you for having us.
Yeah, cool. And thanks, Divakar, for moderating the session along. And thanks everybody for joining in today.